Imagine you're a student. You bring home your report card, and it is just absolutely flawless.
Right.
You didn't just pass. You beat every single expectation your parents had for you. And their immediate reaction, well, they ground you.
Which, I mean, makes absolutely zero sense.
Right. It defies all logic on the surface.
Yeah.
But then, you peel back the layers and realize they didn't ground you for the grades. They grounded you because they just found out you took out a massive secret bank loan and your part-time job is about to fire you.
Yeah, the broader context just entirely eclipses that immediate success. You can really never look at a single report card in a vacuum. I mean, especially not in the capital market.
Exactly. And that perfectly captures the reality we are unpacking today. So, welcome, stock explorers, to this deep dive into BioMarin's strategic transformation.
Glad to be here.
We love unpacking the mechanics of the market for you, so if you enjoy this kind of analysis, remember to drop a like and subscribe to the channel.
Always appreciate it.
So if you are tracking the markets in late 2026, you know exactly what paradoxical report card I'm talking about. In the first quarter, BioMarin Pharmaceutical, ticker symbol BMRN, they delivered a massive beat on Wall Street consensus.
Oh, absolutely massive.
We are talking $766 million in top-line revenue, meaning, total sales before expenses, and a non-GAAP earnings per share or bottom-line profit of 76 cents.
Yeah, and by all traditional algorithmic financial metrics, it was a clear victory. Yet in after-hours trading, I mean, institutional investors just rushed for the exits.
Yeah, they really did.
They sent the stock retreating near its 52-week low.
Okay, let's unpack this. If they are beating expectations, why is the market treating them like a failing company?
Well, the market is a forward-looking mechanism. That Q1 earnings beat is it's basically obscured by deep systemic institutional anxiety. BioMarin is attempting to rip up its floorboards and rebuild its entire house while the family is still living inside.
Right. And let's start with the most expensive piece of that renovation. To really understand the anxiety, we have to look at the $4.8 billion elephant in the room, which is the acquisition of Amicus Therapeutics.
A massive deal.
It fundamentally changes BioMarin's business model. From an investor's perspective, this feels like realizing your high-stakes, volatile tech startup is just too unpredictable, so you buy a portfolio of boring but wildly profitable regional utility companies just to ensure you can pay the bills.
That analogy captures the strategic pivot beautifully, honestly. BioMarin purchased stability. Specifically, they bought two highly commercialized, mature assets from Amicus.
Okay.
First, Galafold, which is a treatment for Fabry disease, and second, a two-component therapy called Pombiliti and Opfolda for late-onset Pompe disease.
Right, and both of these are lysosomal storage disorders. Just to ground this in the biology for a second for the listeners, lysosomes are essentially the cellular recycling centers of the human body, right? So when someone has one of these diseases, those recycling centers get backed up, and toxic waste builds up in their organs. BioMarin has historically built its empire on enzyme replacement therapies, basically injecting synthetic enzymes to do the recycling work.
Right, so they are returning to their core competency, but with a technological upgrade. Consider the specific mechanical advantage of Galafold. It is a first-in-class oral pharmacological chaperone.
Wait, a pharmacological chaperone. So rather than replacing the enzyme entirely, this drug acts like a bracket.
Yeah, that's a good way to put it.
If the patient's natural enzyme is a wobbly chair, the chaperone is the bracket you screw in to stabilize it so the body can actually use it.
That is a highly accurate way to visualize it. For the 35 to 50% of Fabry patients globally who have a specific amenable genetic variant, this drug stabilizes their own dysfunctional enzyme.
Oh, okay.
And because it works so effectively, it is an incredibly sticky, mature asset currently approved in over 40 countries.
So they bought immediate top-line scale.
Right.
But when looking at the mechanics of this deal, the real value driver seems to be a legal maneuver that happened right before the acquisition closed.
Ah, yes.
It involves the Hatch-Waxman Act, which, regulates how generic drugs enter the market.
Yeah. The Hatch-Waxman patent litigation settlement was the masterful de-risking event that justified the $4.8 billion price tag.
Let's see if I have the mechanics of this correct. Before BioMarin finalized the purchase, Amicus was fighting off generic drug manufacturers, specifically Aurobindo and Lupin.
Right.
These generic companies were challenging Amicus's patents, basically trying to force their way onto the market. And if they succeeded, Galafold's revenue would essentially vanish overnight due to cheap competition. But Amicus managed to settle with them out of court.
They did. By settling, Amicus legally secured U.S. exclusivity for Galafold until January 30th, 2037.
2037.
Yeah, the generic manufacturers agreed to back off until that specific date, saving everyone years of expensive courtroom battles. What's fascinating here is that BioMarin didn't just buy a drug portfolio, they bought a decade of legally guaranteed, undepreciating cash flow.
They took a risk of a generic competitor entirely off the table for 10 years.
Exactly. And that decade of protection is the anchor for their future revenue. Securing that kind of predictable cash flow is precisely what institutional investors look for in a mature biopharmaceutical company.
But I mean, security isn't free. Buying a decade of safety cost them $4.8 billion. And looking at the balance sheet, that price tag is exactly why investors are running for the exits.
It's the debt.
Yeah, financing a transaction of this magnitude forced BioMarin to severely leverage itself, issuing approximately $3.7 billion in non-convertible debt.
The debt load is staggering, and the specific nature of that debt is really crucial here.
Because it's non-convertible, meaning they can't just magically turn this debt into stock to avoid paying cash, like you might with a convertible note. They are on the hook for pure, hard cash obligations.
And that cash obligation places an immense burden on their operating margins.
I really have to challenge the management's narrative here, though. They claim they are managing this transition well, but the near-term financials look like a messy demolition.
It's definitely rocky.
Right. In that same Q1 report where they supposedly beat expectations, they took a $31 million charge for a failed manufacturing run for one of their legacy drugs, Naglazyme. That failure alone wiped out about 12 cents of earnings per share.
Yeah.
Add in the massive costs of integrating the Amicus commercial teams, and it looks like the foundation is cracking under the weight of this new debt. Are they growing too fast for their own good?
It's a valid concern. The structural profitability of the firm is undeniably obscured right now. That $31 million charge highlights the fragility of relying on legacy biological manufacturing, which is just notoriously complex.
Right.
However, the real reason the market is punishing the stock goes beyond the integration costs. It comes down to the H2 2026 risk.
The second half reliance. Management updated their 2026 full-year revenue guidance to a midpoint of roughly $3.87 billion. But when you look at the quarterly breakdown, they have precariously backweighted the year.
Highly precariously. Over 55% of total revenue and roughly two-thirds of their non-GAAP EPS rely on a flawless second half of the year.
Wait, let's clarify non-GAAP EPS for a second for everyone. CAP stands for Generally Accepted Accounting Principles.
Right.
When management reports non-GAAP earnings, they're basically asking investors to ignore the messy, one-time costs of moving the furniture around during this acquisition. They are saying, if you ignore the massive integration costs, our core business is highly profitable.
But you cannot simply ignore those costs when a company has $3.7 billion in non-convertible debt to service. Any supply chain hiccups, any friction integrating the Amicus sales force, or even broader macroeconomic shifts could lead to severe downward revisions in that second half. They have left themselves zero margin for error.
So they're sitting on a mountain of new debt, relying on a flawless execution in the back half of the year. And to make matters worse, this desperate need for immediate revenue brings us to the legacy business. Their current biggest moneymaker is under unprecedented attack.
The achondroplasia battlefield. This is the crux of the institutional anxiety.
For years, BioMarin operated a strict monopoly in this space with their drug Voxzogo. Achondroplasia is the most common form of dwarfism. Historically, Voxzogo was the only game in town, accounting for nearly 30% of the company's total revenue.
A massive chunk.
But in Q1 2026, Voxzogo only grew an anemic 3% year over year.
And a 3% growth rate in a supposedly dominant franchise indicates a market that has just paused. Physicians and patients are actively evaluating highly disruptive alternatives that have fundamentally changed the standard of care.
To understand the disruption, we really have to look at the biology. Achondroplasia is driven by a genetic mutation that hyperactivates a specific pathway. It essentially slams the brakes on bone growth.
Right.
Voxzogo is a daily subcutaneous injection that counteracts this, essentially pressing the gas pedal to overcome the brakes.
But a daily injection means 365 shots a year, often for a very young child.
Which is brutal.
The physical and emotional burden of that regimen is immense. This opened the door for the first major disruption, which is Ascendis Pharma's drug, Uviol.
Uviol was approved in early 2026, and it utilizes a proprietary technology that allows for a once-weekly injection. You're taking a child from 365 shots a year down to 52.
The reduction in treatment burden is significant, and the clinical efficacy is superior. In older pediatric cohorts, ages 5 to 11, UV-Well demonstrated an annualized growth velocity improvement of 1.78 centimeters per year.
Oh, wow.
Yeah, it is a monumental upgrade in pediatric quality of life.
But the weekly injection is just the opening salvo, right?
Yeah.
Here's where it gets really interesting. The existential threat to BioMarin comes from a completely different approach. BridgeBio's drug, infigratinib.
Right, unlike the biological injections, infigratinib is a highly selective oral tyrosine kinase inhibitor.
It's a pill, and mechanically it attacks the problem differently. If Voxzogo is pressing the gas pedal to fight the brakes, infigratinib is a targeted chemical that simply takes the keys out of the ignition of that mutated pathway altogether.
Exactly. And the clinical data from their phase 3 trials is staggering. This oral pill showed a 2.18 centimeter per year growth increase.
That's huge.
Furthermore, it was the first therapy to demonstrate a statistically significant improvement in upper to lower body proportionality, correcting a core physiological feature of the condition rather than just driving vertical growth.
The parental choice here dictates the entire market. You go from 365 shots a year down to 52 shots to simply having your child swallow a daily pill, and the pill delivers better growth and better body proportionality.
It's a no-brainer.
The previous Wall Street estimates forecasting $4 billion in peak sales for Voxzogo are officially dead.
If we connect this to the bigger picture, BioMarin's management is acutely aware of this clinical obsolescence. It explains their aggressive shift toward legal defensive maneuvers. They have filed an International Trade Commission, or ITC, patent lawsuit against Ascendis.
Wait, why the ITC instead of a standard federal court?
Because the ITC is a trade court that moves incredibly fast and has the power to issue exclusion orders, literally blocking a rival drug from crossing the U.S. border. It is a brutal instrument of legal attrition. BioMarin is alleging patent infringement in a desperate attempt to stall Ascendis's commercial rollout, protecting their market share through litigation while their clinical monopoly crumbles.
So they are fighting a desperate rearguard action to protect the cash flow they need to service that Amicus debt. And this exact financial pressure, this need to protect the balance sheet at all costs, explains BioMarin's most shocking decision of 2026.
Yep.
They voluntarily pulled the plug on what many consider the future of medicine.
The global market withdrawal of Roctavian. This was a watershed moment that forced the entire biotechnology sector to reevaluate the commercial viability of gene therapy.
In February 2026, they completely pulled Roctavian, their severe hemophilia gene therapy, off the market. The numbers leading up to this were brutal. I mean, it generated a microscopic $3 million in Q1.
Practically nothing.
But why the spectacular failure? The narrative around gene editing has always been that it's the ultimate medical breakthrough. One infusion and the patient is cured.
The narrative rarely matches the clinical reality, unfortunately. Roctavian suffered a profound failure of product-market fit, driven by severe clinical trade-offs. To successfully displace an existing, well-tolerated standard of care, a novel gene therapy must offer pristine safety and lifetime durability. Roctavian offered neither.
So what was the actual patient experience that killed the demand?
Widespread and significant liver toxicity. The vast majority of treated patients experience severe liver enzyme elevations as their immune systems recognize the newly altered liver cells as foreign invaders and, well, attack them.
Oh, man. So to stop the immune system from destroying the liver, patients were put on prolonged regimens of corticosteroids. So, as a patient, you are trading the burden of hemophilia for the debilitating side effects of heavy steroids. We're talking weight gain, severe mood swings, and immune suppression.
And the ultimate failure was that the cure just wasn't permanent. Over a 5-year clinical follow-up, the actual expression of the blood clotting factor VIII dropped dramatically.
So what wears off?
Exactly. The durability of the treatment was failing. Meanwhile, existing prophylactic treatments, like Roche's Hemlibra, work wonderfully to manage hemophilia without these massive liver and steroid risks. The commercial demand for Roctavian simply evaporated.
So we have to look at what this failure means for the company's identity. I mean, did they just waste hundreds of millions of dollars and years of research chasing a ghost? Did they pull the drug just to stop the bleeding?
In a strict financial sense, the sunk costs are immense. However, strategically, the decision to abandon Roctavian is the actual strategic validation for the Amicus acquisition.
Wait, really? You're saying they deliberately killed their own gene therapy just to free up the cash to pay the Amicus mortgage?
Precisely. Under CEO Alexander Hardy, management realized the one-and-done gene therapy model has massive capital intensity, immense regulatory friction, and total commercial uncertainty. By terminating Roctavian, they halted the cash burn immediately.
That makes a lot of sense.
That preserved capital is the exact mechanism allowing them to service the $3.7 billion debt they took on to buy Amicus.
They traded the volatile, high-reward dream of genetic cures for the reliable, unsexy cash flows of chronic, rare disease management. They basically stopped trying to cure patients once and went back to treating patients forever.
It is a fundamental and ruthless shift in corporate philosophy, driven entirely by the realities of capital allocation.
So, if the legacy dwarfism drugs are bleeding onto competitors and the gene therapy dream is dead, how much time does BioMarin have before the market completely passes them by? For the investors listening, what is the ticking clock here?
The clock is dictated by 3 upcoming milestones or catalysts. The first involves extracting the last remaining value from Voxzogo. While it is losing the achondroplasia market, BioMarin is aggressively attempting to expand the drug's label to treat a related condition called hypochondroplasia, or HCH.
Right, HCH is a related genetic skeletal dysplasia, but with a milder phenotype. There are currently no approved therapies for it, meaning it's a completely untapped 14,000 patient market globally. BioMarin plans to file a supplemental new drug application in Q3 of 2026, and the trial data there look very strong, showing a 2.33 centimeter per year growth advantage.
The clinical efficacy in HCH is clear, but the regulatory risk is substantial. There is a definitive cap on how broadly they can apply Voxzogo. The company was forced to halt other expansion trials due to severe safety signals, specifically something called slipped capital femoral epiphysis.
SCFE. It's a terrifying hip injury where the head of the femur literally slips backward off the bone. Now, BioMarin stresses that this specific injury hasn't been seen in the core achondroplasia or HCH patient groups, but the fact that it appeared in other Voxzogo trials puts a permanent ceiling on the drug's total addressable market. Regulators will be highly cautious.
Which leads to the second catalyst. If Voxzogo's ceiling is capped, BioMarin must prove they have a successor. This is the role of the Core 5 and BMN 333, their proprietary next-generation, once-weekly injection, currently in the ACE-PEN Phase 23 clinical trial.
They are running BMN 333 head-to-head against their own daily Voxzogo to definitively prove it is the new gold standard. But this raises a massive timeline issue. The target commercial launch for BMN 333 is 2029. Are they simply going to be too late?
That's the million-dollar question.
Because if BridgeBio gets their oral pill approved next year, the market will have 3 full years to transition entirely to a convenient daily pill before BioMarin even shows up with a new weekly injection.
That is the paramount strategic risk confronting their pipeline. BMN 333 could emerge from trials clinically superior to older injectable therapies, yet find itself technologically obsolete upon arrival compared to an oral standard of care.
And finally, the most immediate catalyst is the Q2 earnings call scheduled for August 6, 2026. This is where the narrative meets the math. Investors will demand proof that they can actually hit that back-weighted revenue guidance.
Oh, definitely.
But more importantly, they need to see progress on the debt. The magic number management has promised is bringing that Amicus debt down to less than 2.5 times gross leverage.
Right. In gross leverage, calculating total debt divided by earnings is the critical metric for institutional confidence. If leverage remains elevated above that 2.5x threshold, credit rating agencies take notice, the cost of future capital spikes, and the operational flexibility of the firm just vanishes. That August earnings call will be the ultimate litmus test for management's credibility.
So, to summarize the board as it stands for you guys, BioMarin in late 2026 is a highly de-risked but highly indebted transition story. The floorboards are pulled up and the loans are signed. They are systematically dismantling their reliance on a vulnerable daily injection, retreating from the failed promise of gene editing, and locking in a decade of rare disease cash flow through the Amicus deal to survive the coming storm.
Well said.
Thanks for exploring the markets with us today. If you enjoyed this, please drop a like and subscribe to Stock Explorers for more deep dives into the mechanics of the market.
Before we conclude, there is a broader implication here worth considering. In a world where one-and-done genetic cures were supposed to be the ultimate holy grail of biotechnology, BioMarin's 2026 pivot suggests a controversial reality.
Which if
treating a disease forever might just be a fundamentally better business than curing it once. What does that mean for the future of medical innovation?
that is a fascinating and somewhat chilling thought to leave on. We'll catch you on the next deep dive.